Hey everyone, welcome to the Rich by Decision podcast. I am your host, Evie Amina, and we talk about investment, personal finance, and your business. And today we're going to talk about financial statements. You see, financial statements are a metric of how well you handle your money. In our first episode, we talked about the 5 most important words of money. The words were income, expense, assets, liabilities, and cash flow. And each of those words are found in 3 particular financial statements that every person, every corporation, every government has. Whether you know it or not, you have them. Okay. And the 3 financial statements are income statement, the balance sheet, and the statement of cash flows. So today we're going to have 3 parts to this conversation. We'll first cover the income statement. Then we'll go into the balance sheet, and then we'll close it out with the statement of cash flows. So let's begin. So the first statement is the income statement. It goes by a couple other terms, the statement of operations or P&L, short for profit and loss. And essentially what it measures is your performance of you or the company or a government. And essentially is how much money is coming in and how much money is going out, right? The money that comes in, that's known as your income. Okay, and then there's 3 types of income. There's earned income, income that comes from your job. There's portfolio income, income sold for capital gains. For instance, if you bought a stock at $10 and you sold it for $20, you sold it for a $10 profit. That profit is known as capital gains. So that would be considered portfolio income. And then the last would be passive income. And that passive income is income of which you're not actively involved in. So like a real estate investments that you get paid every month and you didn't have to essentially work for it. So that's found in the income section of that statement. And then that's the money you bring in. And then the money that you spend is known as your expenses. My proper definition to that is things that you must spend on in order for you to maintain your current lifestyle. It might be your current operations or your current governance for a community. So there you'll find fixed expenses. These are things that you know the cost for each month. Like, so for instance, your Netflix subscription account, you know that in the month of January, it's going to be $9.99. And then down the line in the month of November, it's still going to be $9.99. That means it's a fixed amount each month. And then you got variable expenses. These are expenses that just vary between, how much you spend in that given time period. So in a given month. So maybe one month you might be having, you're not going to be spending much on your heater bill, right? Because you're probably in the month of maybe September. It's cool enough, but not hot enough. And then as you get into the winter, you're probably going to be cranking that heater up. So the heater bill is probably going to be higher than usual. So that means that expense varies. Okay. And then what happens is you come out with a result, whether you make more money than you spend or you're spending more money than you make. Okay. And so if you make more money than you spend, meaning you have some money left over after spending it, you are at a net profit. If you are spending more money than you're making, right, that's called a net loss. All right. And so that just tells you how well you perform with your money. And that is found in the income statement. Okay. Now we move on to the next financial statement. This is known as the balance sheet. And essentially the reason why it's called a balance sheet is because there are 3 components to the balance sheet. It's assets, liabilities, and owner's equity. Owner's equity could also be known as someone's net worth. Okay. And what happens is the equation that makes it balance is that assets, the amount of assets you have should equal the liabilities that you own and also the net worth that you have. So A plus L plus, let's use net worth NW. Okay. So what happens is the liabilities plus the net worth side should be balanced off or equal to what's on the assets side. So here we find, right, with the assets, there's things that you own that, in general accounting and principles terms, it's anything that you own, right? It could be a TV, it could be the couch, it could be the car, it could be the value of your home. But what I would push for everyone here is to go far and beyond that term and only itemize assets that either appreciate, means it goes up in value, or it pays you to own it, meaning it gives you some sort of passive income. So it could be a stock that gives you a dividend. It could be rental income that you receive from real estate. I would itemize those in your balance sheet and stay away from what most financial advisors and other people would say that you could use to determine your assets, like your bikes, your cars, and all that. I would stay away from that because cars depreciate in value. Houses, give or take, could depreciate in value, but it's not really the depreciation part that people worry about. It's actually the mortgage part or the liability section of it, because technically you have to pay a mortgage each month, so it's actually money coming out of your pocket. So most investors, especially very successful investors, believe that your house is not an asset, and I've mentioned that in my second episode. So what you want to do is you want to itemize all your assets that go up in value or that pay you to own it. Okay, so you're going to list that there. In your liability section, that's money that you owe. So if you have credit card debt, you want to put the total amount that you owe. If you have a mortgage debt, you want to put on the total amount that you have left over to pay. If you have a medical expense bill that's really large, you got to pay it in monthly payments. If you have a car loan, student loan, you want to put the total amount that you owe. Okay, and if you can calculate all the interest as well, you want to put that there. Okay, because liabilities are things that you have to owe money to. So it's essentially your debt. So you want to list it all there. Okay. And so what happens is what we're going to do is I know I talked about how it's A equals L plus NW, but I'm actually going to switch this up because what it will do is it will teach you how to calculate your net worth. So how you calculate it is you switch up the equation. What you do is you take all your assets that you have, you subtract it from all your liabilities that you owe, and whatever you're left over with is going to be your net worth. Okay, so all the assets that either go up in value or pay you to own it, minus all the debt that you owe, whatever you're left over with is what you're worth. Okay, so to go on a side note here, this is why I get really upset when I see on social media people getting angry with folks like Elon Musk or Jeff Bezos of Amazon, saying if we had their net worth, we could probably, end hunger or end homelessness or whatever. But the problem that they're doing is they're arguing on grounds of which they have no idea the definitions of the statements they're making. So not a lot of people even know how net worth is calculated. Okay. And I learned this from studying, I referenced this with the Investors Podcast. Preston Pysh and Stig Brodersen created a free online course. It's called Invest Like Warren Buffett, that taught me how to look at money. It's very, very easy to understand. I highly recommend people to hop on YouTube, go to there, just type in Preston Pysh, Preston, and then last name is Pysh, Pysh. Or you can type in Invest Like Warren Buffett. The course is there. I think it's a 3-part course. Very, very informative. And, Preston really goes into depth on how to calculate net worth. So that's going to be your balance sheet. Now, the third statement is known as the statement of cash flows. And what this does is it tells me how cash is involved between the first two financial statements. Now, if you guys ever read the book Rich Dad Poor Dad by Robert Kiyosaki, he has this diagram with the income statement and the balance sheet, and he uses these arrows and he draws pathways on how the poor class use their money, how the middle class use their money, and how the rich class use their money. And essentially, that arrow that draws these pathways, that's what the statement of cash flows tell. It tells the true story of what's going on with your money. Okay, so in the statement of cash flows, there are three areas to it, or three components to it. The first one is called cash flow from operating activities. Okay, I know it's a very, very complex word, but if we take operating just means what you constantly do. So if we had to look at just you, how much money are you generating from your work, right? Your operations, your day-to-day work. You take that and whatever cash you generate from, that's essentially your cash flow from your, exactly what it says, operating activities. So that's where the cash would be logged in. Okay. The second component of the statement of cash flows is known as cash flows from investing activities. So in this one, you're going to list all the money you're making from your investments. So if you have rental income from your real estate property, it's logged here. If you have money from selling a stock for profit, selling crypto for profit, I mean, what